Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 42. As always, joined with the three amigos. We got Keith Dicker of IceCap Asset Management and everybody's favorite Tom Brady of Macro, Rich Diaz, who is departing from Keith's homeland today and moving to Montreal. So any single ladies in Montreal, Rich will be there with his pickup lines. Be careful. But what's going on? Rich was here in Vancouver last week. You know, it's getting serious when he meets the fam. So he came over and had dinner with my family, and we had a time.
What did you guys talk about me?
Oh, yeah.
we talked about how we're going to make you jealous. I had a really nice bottle of white and a bottle of red. And Steve's wife made us a gorgeous, gorgeous dinner. So, yeah, you should be very jealous. That's all we talked about.
I think then, we talked about having a kitchen party at my place here in Halifax. I think everyone on the West Coast, let's go to Kitsilano and hang out at Steve's place, for the night.
Come on down. We're already, we've talked about before, but we are in the works of some future Loonie Hour live events. We just, maybe first announcement here, we just picked up a sponsorship with ShakePay. So an exclusive sponsorship with ShakePay. Huge thanks to them. Obviously, this podcast has been growing, extremely fast and definitely has been much better than anticipated when we first launched it. We said, hey, you know what, let's just see if it sticks. And crazy how quickly things have kind of moved along, but we obviously appreciate everyone's support. So all we ask is, again, you guys are really ultimately driving the growth of this channel. All we ask is that you continue to share this with at least one family member, one friend, and just build it one by one. But let's get into the show this week. I think there's so much happening. Actually, I think the big theme this week is kind of like a lot of what we've been talking about on the show seems to actually be manifesting now in markets and in sentiment and narrative in the media and stuff. So, I mean, first and foremost, let's start off on the Canadian housing front, given that this is the Canadian podcast. RBC calls for a quote historic, what do they call it? A historic correction. They didn't call it a crash. They called it a historic correction in the nation's housing market, basically calling for a 12% decline in the national house price index by the second quarter of next year. So I kind of want to break that down for a few people. Keith's going to get behind it on the bank ramifications of, why a major Canada's largest bank would come out with this, rather aggressive forecast. But I kind of want to unpack the numbers a little bit for you guys, because there's some, when that was released, right? Like the media kind of ran with it, but everyone's like, well, what do you mean 12% correction? Like, that's like we're already down 12% in most markets. And so it's kind of a simple reminder that the national house price index in Canada is measured with all of these cities, areas. It's not measuring like the average sales price of Toronto suburban homes, right? So it's kind of lump sum. It doesn't really move. It's a lagging indicator. It's a smoothed out index. I believe it uses a 3 or 6 month rolling average of prices.
Three.
Rich will probably know just as well. But just to kind of give you some context, so that 12% decline would actually be the steepest correction that we've actually seen over the last 4 downturns going back to the 1980s in Canada. So it's not like a small, while the 12% headline sounds small, it's actually, statistically speaking, would be the largest decline on a national basis. The other thing, so if you look at the numbers, so during the financial crisis of 0809, again, I just think that this number is ultimately wrong. This is why we don't like use national home price indexes per se. But during the financial crisis of 2008, 2009, national home prices in Canada declined by 9%. Okay, so as of right now, if you look at the National House Price Index, we're down 6.7% from the peak. So if RBC is correct, we're basically halfway through roughly this correction. But yeah, just to give you again context, the world was ending in 08, 09. Per that index, prices only dropped 6.7%. We know in Vancouver and Toronto, they actually dropped more like 15%, give or take 20% in some pockets. But Keith, I don't know if you have any thoughts on that call, because obviously it's pretty large ramifications just from like a sentiment standpoint, right? Like, this is Canada's largest bank.
Yeah, I think it's really odd that they did this, and I would imagine someone within the mothership wasn't very happy with that report going out. Because if you think about it, I mean, they're in the business of selling homes, right? That's what they do. They provide financing for stuff. And for the research department, the economics team to come out suddenly and say, yeah, the biggest stuff that we sell, we think it's going to come off, by X% or something. It's, that would be alarming, because it does, the news does travel pretty quickly. But it's the economics team, and that, that is their responsibility. They're supposed to give you thought-provoking pieces or research narratives, whatever it is. They're never, always right or always wrong, but they want to give you something to think about. So you have that going on. And so what I think it's great about it is because, we've been talking about this for a while, and everything has a narrative. Now, RBC especially, they're going to be in an awkward moment for their next earnings that's coming up. Because it's been, I know for us, it's been our expectation that growth is going to slow, and then all of a sudden hey, this could stop pretty dramatically. And now everyone is expecting it. And we had the US number this morning. We can dive into that as well. But what we got everyone with, look at what are the banks telling you? What are they telling us? What are they reporting? And the American banks, it's just because of the way they're on a calendar quarter basis. The Canadian banks are not. But what's happening to the American banks, they're taking more losses for the loan portfolios. They're taking losses for leverage loans that they're doing, leverage buyout option that they're doing as well at the same time. So again, I suspect when the Canadian banks come out with their earnings now next month in August, you're going to see a similar narrative taking place. And, they have to get ahead of the game. And I think some of these loan provisioning numbers will come out. I think they're going to be really aggressive, because if other people have already started to do it, you're not going to be blamed for doing it. Like, it won't be a one-off, blue shirt bank problem or orange shirt bank problem. It'll be for everyone. But that's the first thing. And it will have an impact on investment strategy. I want to come back to that as well as we get into it.
No, absolutely. I think the RBC economics team needs to hire the forecasting team at Royal LePage, because they have never released a negative housing forecast. I think they're actually still calling for like a 5% increase or something like that this year. So God bless the team at Royal LePage. But yeah, speaking of that, I actually do have an update from RBC. So actually, I have my own mortgage at RBC. So we've talked about this on the show before about these trigger rates, and if the Bank of Canada does in fact raise mortgage rates at their next meeting in September, which we'll get into because I've got some comments on that following a lot of this Fed talk. That a lot of mortgages would actually get triggered. And I think we're starting to hear a few stories now that people are calling in, asking questions. I think there are a few people that are basically getting triggered or like 25 basis points away from it. So I actually had a chat with my broker at RBC. And so just kind of asking, well, how are you guys anticipating? Joel, we're getting a lot of phone calls on this, and there's basically three things that they can do, that they're going to do. So basically what RBC is doing. So what happens is at some point, right, is that so much of your monthly payment now is only going to interest, that it basically becomes an interest only loan at the bank. And so that's what that trigger rate does. The trigger rate basically says, well, we got to get you paying more so that way you're paying some principal. And so what basically conclusion was, is that what RBC is going to do, Canada's largest lender, which I would think other banks will probably follow to some degree, is that they're actually just going to increase your monthly payment to make sure that you're paying at least $2 in principal payment. So she's like, this
Toonie.
like
It's a toonie.
toonie. That's all you got to do is you got to pay a toonie. If you get triggered, you have to pay a toonie. But she's like, yeah, like obviously most people are coming in and saying, well, you know, the strategy of like set it and forget it and don't touch it is probably not the best strategy over a 5-year period. So she said, you know, a lot of people are calling it and increasing their payments. But the amount that you'd have to actually increase the payments to get back on like your amortization schedule is actually quite significant. So I think like she's like, yeah, in reality, most people are increasing their payments by, you know, $100, $200, $300 a month, and keeping it right, and just understanding that, you know, you're not going to get back to the amortization schedule. So that's kind of what's happening on the trigger rate side of things. So it might not be as big as of a story as everyone's kind of hyping it up to be. I think the reality is that it could be more of a problem in 2, 3, 4, 5 years when a lot of people go to actually renew their mortgage and they have this, you know, this balance which maybe hasn't been paid down, assuming interest rates basically stay where they're at, which again I'm sure we'll get into in this show.
That's assuming your bank is around to collect from you in 5 years.
Can I ask you a question though? Because I guess, you know, I know we talk a lot about the negativity on the housing market, and I understand the interest rate perspective. I understand the banking sector constricting loans. But, you know, I was just looking at the population growth numbers for Canada, and we're already back to 1.3% year on year. Canada just cracked 38.5 million people. If you look at the population growth for prime age individuals, which is age between 25 and 54, you're at 1.4% year on year. That's a 30-year high. And then, you know, so I get the view that, you know, you've got constricting borrowing, although that's not necessarily true. If you look at the senior loan officer survey, it remains quite imbalanced. And then the other thing on is the type of housing. So for example, if you look at constructions, I was looking at sort of top level stuff. If you look at homes under construction, and, you know, whether it's Ontario, Alberta, whether it's Quebec, you know, there's a series in DataStream, which is, and from Stats Canada, called Units Newly Completed or Unoccupied. And, you know, that under, and then there's also under construction. And then under the construction section, there's apartments, single detached units, and other. And across the board, apartments just keep ratcheting higher. And then, but the single detached units are still well within either, you know, 15-year lows, or, you know, and so, you know, I think the problem when we look at these averages and we have discussions about, you know, the marginal price, et cetera, I mean, isn't there just a floor that's being set sort of underneath these house prices, whether it's single detached units rather than, let's say, condos, as a function of A, supply, and B, demand? I mean, isn't that like sort of the counter argument to this, is sort of the housing negativity?
Yeah, I mean, I think that everybody just loves to like hate on housing. I get it, because it's like we definitely have egregious prices here. So naturally I can see why people are frustrated. But I do my best to try to take the emotions out of it. I can speak specifically on like Vancouver, Calgary. I think Toronto's in a similar sort of dynamic, because like usually when you talk about Canadian housing, you're talking about Vancouver and Toronto.
Yeah.
I can say specifically like in Vancouver, Rich, you were here and you visited, like in the city of Vancouver, like there's nowhere to build new single family houses.
Yeah.
There's no like tract of land that you can like, oh, that like over there, let's go build a new community and plop 1,000 cookie cutter brand new single family houses. Like there isn't. So what's happening is like the stock of single family housing in basically all of greater Vancouver contracts every single year, because they're being densified. You know, they're being land assembled into townhouses and condo buildings and duplexes. So like, I think honestly, fundamentally, like if you own a single family house over the next 10 to 15 years, like you own, I would say, a finite asset.
Right.
Now, if you're buying a condo, to be honest with you, I think we're just going to keep building up. So I think there's tons of supply. So I think like the argument there for like price appreciation, I'm not as convinced, but I think if you own the underlying land in some of these land constrained, metropolitans. I mean, the same could be said for all sorts of different large cities, not just Vancouver,
Right.
but when you're constrained by the ocean and the mountains, like.
Yeah, I guess I think it's just that we need to be sort of careful. I think when we discuss house prices and home prices, when I think sometimes we're guilty of sort of lumping it all into one thing rather than specifically about condos or single detached units or multifamily, whatever. Because if you just look at those supply numbers, it's amazing, really. And then those population growth numbers are wild. They just the immigration, the taps are open again. Right or wrong, I mean, I don't really care, but the numbers are very, very clear. Where the growth is driven by immigration, and we're back to 1.3% year on year after sort of the COVID hiatus. And so that's why, even though I wonder about the bank's ability to lend and finance those next purchases, I'm always really cognizant of sort of that like floor under any price decline. And the affordability hasn't helped. Obviously, that's a negative for housing, but it's amazing how much that's it's just something we should just think about, sort of the demand, and then obviously the type. But anyway, so that was my 2 cents.
Oh, I mean, I think let's not putz around here. I mean, at the end of the day, you've got a lot of these markets, in the suburbs of Vancouver, the suburbs of Toronto, like they're already down 20%. And yeah, they could easily drop another 10%. 15% over the next 6 to 12 months, easy. So, I mean, hey, a 35% correction in a lot of these markets, I mean, it's pretty. But aren't you just back? It doesn't happen every decade.
But aren't you just back to sort of 2019 levels? I mean, you've made that joke before, right?
Yeah, I mean, it's true. Like everybody knew there was a suburb or a bubble in the suburb.
Yeah. Okay.
Everybody knew it. It was insane. It was pandemic driven. Everyone's like, I'm going to work from home forever and live off the grid. Like everybody knew it was a bubble. And so it shouldn't be a surprise that it's bursting, and the fact that rates are up at their fastest pace ever. But now I want to kind of jump into that now, because I want to talk about economic growth. We just had the US's latest GDP print. I can just speak specifically on growth and housing here for my last comment. Is I'm just looking at the July figures right now. What do we got? A couple more days left in July here. Greater Vancouver home sales. So not just the city, Greater Vancouver, the whole region. We will see basically a 20+ year low in home sales for the month of July. So again, this is just accumulation. Rates are simply too high for the market to function. There's not a lot of liquidity. I think that's obviously going to play into economic growth. So, I mean, Keith, Rich, I'd love to get your guys' comments on, as of this recording, US GDP for Q2, another decline. So it's 2 consecutive declines. Some would say that's a technical recession. We're not calling that, apparently. That's, someone tweeted me and said, this recession does not identify as a recession. Well,
it's the labor market. Just so people understand, there's a misconception about the two negative quarters that are consecutive. I mean, that's sort of the colloquial definition that people, but there's always, it's usually it is subjective, and there's always supposed to be some kind of labor market contraction, and we just haven't seen that, just so that people know.
Keith, are you got any looking at the numbers here? I mean, what's your thoughts? I think it's because you had Biden out saying we're not in a recession, and then I think Janet Yellen is out today, I think, talking about she's calling it a transition now. So it's a recession that doesn't identify as a recession, but it's going through a transition.
So I mean, there's a lot to unpack here, but let's be clear about a couple things. The economy is rolling over. Okay, you're splitting hairs to say whether it's this or that. The only reason all of a sudden in the last 48 hours that this whole argument or discussions come out is, what is a recession, what isn't, it's because in the White House, we have the midterm elections coming up in America in a couple of months. And usually the way it works politically, let's just think there's just 2 sides, because we're looking at the American side. Both sides have wins in something, and then they both have losses in something. So they're both able to campaign on hey, we won this, we won that. Right now, the White House has no wins. They've lost on inflation. They lost on geopolitics. They've lost on the pandemic is now over. They can't use that again. All of a sudden now, the one thing that they were campaigning on, hey, we have a great recovery, the economy is doing well, lots of jobs, and boom, out of nowhere, because it happened quickly, now they're staring at a recession. So politically, the other side, which would be the right or the Republicans in this case, and like they're in inflation, gas prices are going up. Now we're in a recession. I mean, this is going to be hammered home relentlessly for the next 3 months in America. So the White House came out and said, you know what, it's not really a recession. So they changed the definition. That's what they're trying to do. That's why they're having this discussion. And again, from our perspective, it's irrelevant whether you're a shade into recession or not. The point is growth is starting to slow. And it's our expectation that after the next quarter, it's no longer going to be, it might be a recession. I think we're rolling dead on into it. So with the GDP number, from a very simple perspective, your economy is calculated based on spending by individuals, companies, and government, right? That's where it comes from. And then you have net trade, what's going on. So if you are a net exporter all the time, it's always positive, for your economy. If you're a net importer, which is what the Americans are, I mean, it's negative and all that. This latest GDP number, everything was weak. Like there wasn't any real strong wins or real strong losses in there. And one of the biggest contributors to the economy in the US and elsewhere over the last, really year has been the inventory build. And even that is starting to slow down now. So I know a couple of shows ago, we talked about, hey, this fall, you might all of a sudden have a lot of sales happening at the retail stores because inventory's been built up. They run into recession. I think that's where we're going as well with it. But what this does now from an investment perspective, so the world has shifted, and it's happened now fast. We're on top of it because we're a bunch of smart fellas, of course. And but the world has gone from looking at inflation is surging, interest rates are surging. It's just a horrible time to try to do stuff. Housing is going up. To now all of a sudden, hey, we're in a recession. House prices are coming down. Maybe the central banks are going to stop raising rates. Maybe they'll cut rates next meeting. Like we've done a complete 180. So from an investment perspective, I know every week, I'll allude to certain things we're doing with portfolios, and I'm not going to announce in real time what we're doing because it's just not fair. But about 3 weeks ago, we bought long bonds for our client portfolios for our Canadian dollar strategies. And it was on the expectation that, the recession drum was going to get louder, the drum would get louder, and that long-term rates would start to creep down. So we thought, hey, that's a great time. You buy low and sell high and everything. So we're up around 6-7% on that move right now. And our expectation was maybe it'll be a 10 to 15% opportunity. So we're halfway there. And as the recession drums get louder, we think this trade will continue to work for us. However, it's not one of these, buy and hold things. It's not going to last forever. So we suspect we'll have this recession talk. Maybe the central banks will stop hiking rates. We think this is maybe a 1 to 2, 3 month lull. Gully maybe, and then we'll it'll swing around the other way. And I think that's what's so fantastic right now about the market. Like we're getting these extreme movements. People are chasing their tails. I want to comment as well one more thing. I know I sent out that RBC tweet about the housing market a couple of days ago, and a couple of people reached out to me. And everyone. So the difference today is that everyone's on social media and like all the news pieces are amplified, and the Canadian banks, there's not going to be a bank run right now on Canadian banks. They're not in trouble. You don't have to go and yank out your money and all that. Like that is not happening. We're just the beginning of a period where likely, growth is going to slow and you're going to see some negative consequences with it. But I'm just, suggesting people don't be alarmed by everything because it is amplified. Maybe it will change as we go on, and we'll give you the heads up here, of course, when it does. But again, where we're headed over the next few months will be a 180 from what we just had, and maybe you'll get a boomerang on the other side.
Well,
I do have
that's what
comments on the Fed. I will come back for the Fed though.
Well,
for monetary
That's
policy.
what I wanted to say that because, well, just for clarity, so that people don't get don't misunderstand anything. Exports and consumer spending increased, by the way, in that second quarter. The other sections, which were inventory investment, housing investment, federal government spending, state and local government spending, and business investment, all decreased. So just so we're clear about what went up.
A
And what
question on
went
the
down.
consumer spending side. I don't know. I haven't really looked at the report, but on the consumer spending side, I'm assuming it doesn't adjust for inflation.
Yeah, it does. It does. It's real. It's real.
Oh, it is. Okay.
Yeah, for sure. Whenever you, it's an excellent question, by the way. But whenever you have a GDP print, it's in real terms, so it's adjusted for inflation. It's adjusted for a different type of. Remember, I always screw this word up: implicit price deflator, instead of using the CPI or the PCE, which is personal consumption expenditure. There's a different index that you use to get from nominal to real. And for the U.S., it's an implicit price deflator for consumption, which is closely linked to CPI. But anyway, I just wanted to make it very clear that not all of the parts of the economy went down. But I think that what's more interesting, rather than sort of the recession, whatever, I mean, that's for me, that's sort of less interesting from a strategist perspective than the market's making new highs, and the yen is starting to rally, and Bitcoin is up. And I think you're looking at the Nasdaq's making a new high, and oil still at 100. So I think so. We always talk about this, that people and clients and listeners shouldn't conflate necessarily the markets with the economy. And I think you could make the case, if you wanted to be a little bit punchy about it, that a lot of this bad news has already been priced in. Because, the market is a forward kind of looking indicator, right? It's always trying to assess what's the next thing down the line. The market today is not telling you what's happening today. The market right now is sort of discounting what the future cash flows, what's going to happen over the next 6 to 12 months is already happening. And so when you see the sort of the negative, whether it's consumer confidence, whether it's business investments, whether housing prices, whether it's, et cetera, et cetera, et cetera, and you see on that negative news that the stock market doesn't go down, you could make the case that all of this sort of negative stuff has been priced in. Now, the other side of that is we're in a bear market rally, and who knows what's going to happen. But I think it's just important to contextualize the fact that the Nasdaq's making a new high. I'm looking at Bitcoin's just hit 23,000. Oil's at 107 on the Brent. These are not recessionary red flag indicators. And so I just think it's a really sort of fascinating dichotomy between the red flags from the economy and sort of a green lights from the markets. I don't know what you guys had a view on that.
Yeah, I mean, I just think it's just kind of this year, I think, is just serving up a lot of humble pie all over the place, right? I think, I don't know, I love Twitter. Obviously, I spend probably way too much time on there, but the amount of people that are convinced they know with a 100% certainty of what's going to happen and what the price target is, it's just mind blowing. And I think I think a lot of people just think with emotion or actually, investing or positioning or trying to create wealth or preserve wealth or what have you. And yeah, it's always just a delicate balance, right? I mean, I think the media definitely amplifies, a lot of the negative stuff, and as Keith alluded to earlier, right? I mean, everything kind of gets amplified today, and it's usually not this or that. It's usually somewhere in the middle. I mean, obviously, I think we're still going to continue to slow. I'm just looking at the housing front, but
well, I'll tell you something that people are not talking anywhere near enough about is something that's not amplified. Is, I know we've talked about earnings a little bit, but to me, it's always the margin story. Margins, just so people understand, non-financial corporate margins are basically at all-time highs, but depending on how you calculate it, whether it's MSCI index or a data stream index, or if you use a national income account, they're all-time highs. And the question is, can you be what will be your price earnings ratio? What will be the performance expectations or expected return on the index on all these stock markets if you have a structurally lower profit margin, sorry, just to be clear, going forward? And I think that that's, to me, the question that not enough strategists and not enough, news outlets. I mean, I guess it's not their job maybe, but that's what I'm thinking about. That's the only thing that dominates my thinking. What will happen to margins going forward? I don't know.
Yeah, I mean, Keith, I don't know if you have any thoughts. I'd love to kind of get into the Fed as well. I mean, Keith, you probably paid more attention to it than anyone, but obviously the U.S. Federal Reserve out this week here, 75 basis point rate hike. But I think more so what people tended to focus on, maybe right, maybe wrong, was the lingo from Jay Powell, which it seemed to sort of indicate that the next sort of rate decisions moving forward would be quote unquote data dependent, that they're no longer sort of, I guess, foreshadowing, these moves, right? Like everybody knew that the Fed was going to raise 75 basis points this week. Everybody knew that. It was basically, again. So Keith, I don't know how much limelight you're putting on the comments from the Fed. I don't know if I personally would say, hey, it was like a full on pivot, but is this like 25 basis points moving forward? Do you think that they're done for this year? How are you kind of looking at the recent comments?
Yeah, they have not pivoted. It's just that the narrative has changed somewhat, and because that's the narrative that we've been sharing. Of course, is that they're going to raise rates, keep going until something breaks. Eventually, like they don't go from raising rates to cutting rates. They go from raising rates to not raising rates as aggressively as they were before, and then they're flatlined, and then the next move is down, and it takes a while for that to play out. So yesterday, there's two big takeaways. One, overall, it did sound more dovish than what was probably intended. And then, like, for example, they effectively said no more forward guidance. So what that means is that in previous meetings, they're saying, like we're going to get up to 2.5% by the end of summer, and up to 3.25% by year end. You should expect that. Now they're saying, going forward, our decisions should be based on the data that's coming out, and that's what the ECB said last week as well. So again, you're getting the central banks are synchronized. So that was interpreted to mean that, hey, maybe they're done, because if we get softer data coming up, they're not going to hike rates. Hey, the party is back on. That's not what we expect. We think that's a bit early for that call. They also have another report. I don't remember the name of it, guys, but Powell said in both his statement as well as in the presser, I forget what it's called. It's, but anyway, the guidance for rates in that publication, he said, we're still on for that till year end. So in one way, they're saying, forward guidance is gone. We're going to use data, but he said, like, not a lot has changed. Like, we still think we'll be at 3.25% here as we get towards year end. So that was the big takeaway from it. The other
is creating an escape valve for himself. Like he kind of has to keep the door open to sort of hit pause, right? I mean,
they'll have to pause, but I can tell you one thing: there's an extremely low probability that they're going to start cutting rates. They don't want to be the ultimate clowns in the central bank world. And the way you become an ultimate clown in the central bank world, that you go from 0 to say 2.5 or 3.25%, just like that. And then all of a sudden you go from 3.25 back to 0 just as fast again.
You mean like Trichet in 2010?
Yeah,
Trichet raised rates, and then within 2 months or what was it? How many months was it? So just so people understand, in 2010, I'm screwing the dates up. Forgive me, I'm distracted this week, but I think Jean-Claude Trichet or whatever his name is was the ECB president before Mario Draghi. And in 2010, was it, they raised interest rates, and then like 2 months later they cut them. Anyway, sorry.
How much did they raise them? Do you remember?
It was 25 basis points, but it was like the attitude. Like he was like, don't worry, everything's fine. And then he had to turn around. Sorry, Keith, please keep going. He
was like, Baghdad Bob. Do you remember that guy? You guys don't remember him, maybe.
Wasn't he the economist, wasn't he?
No, back when the Americans went into Iraq, he was the communications minister. So there was these famous interviews. He's in front of the American, like CNN and stuff, in Baghdad, and he said, yeah, we're still strong. The Americans have not taken the city at all. And meanwhile, like going behind him are the American tanks and things are blowing up and everything. So he, just Google Baghdad Bob and
No. So you know what it was? It was Baghdad Bob, the chief of the National Association of Realtors, the chief economist, I think, leading up to the financial crisis, they nicknamed him Baghdad Bob. I don't know how it came about, but yeah, I guess it was all his communications. Housing is strong, and then it blew up.
Keith, I push you off course, Keith. So I apologize for that, but I think you were making a really good point about like credibility and sort of timing and forward guidance.
Yeah, I think Baghdad Bob's a lot more fun to talk about. I mean, but good old JC, that's what we used to call him. Jean-Claude. Yeah, he, and again, I always call that part of the world the economic fantasy land called Europe. And it's not something that they've earned over a couple of years, like way back then, which is over 10 years ago now. The rest of the world is crumbling economically. Everyone is cutting rates. And, this guy says, no, we're strong here. We're going to raise rates and everything is great. And boom, they got to cut rates and they got to bail out the Greeks and they got to bail out Cyprus, and the Irish are lined up for more money. So the point is, central bankers are people too, they're going to make mistakes. However, the Federal Reserve, specifically Powell, they do not want to be the guy that raised rates aggressively and then said, oh, wow, we made a mistake. We're going to roll them over. Like that will not happen on Powell's watch. It'll be the next person coming in line. And then the other interesting thing that's happening here, people may not realize, but there's a real tug of war or, boardroom brawl taking place right now between the Fed and the Treasury. And it's really aggressive, so that the Fed, they want to raise rates and, put on QT, reduce inflation, all that stuff. And it's irrelevant whether you agree or disagree with it or like or dislike it. That's what they want to do. Meanwhile, the Treasury, which is an arm of the White House, they have a political agenda to, hey, we got to keep this party going as long as possible. We're not able to produce a big deficit this year because politically they can't get it passed in Congress nor at the Senate. So Yellen wants the Fed not to be as aggressive as they have been. So in return, what she's been doing is driving the price of the dollar higher, which really ticks off Powell and the Fed, because you got higher rates going up and then the dollar is just screaming higher, which is going to cause something to break in the emerging market world or elsewhere, which would then mean Powell will have to stop raising rates. You see how it all goes around. So today, for example, and we record on Thursday, so this is Friday, you're listening to it. You have Yellen coming out with a presser this afternoon, and she's going to specifically be commenting on the GDP. And that in itself is incredibly unusual because, 2 days ago, you had the White House change the definition of recession. Then the Fed just came out and the GDP number was horrible relative to what they were expecting. So because it's not a nice, clean world that we're approaching now over the next few months. And, markets can, be going to a different tune. And, but, that's when you get the opportunities, to put your moves on, like Baghdad Bob.
I got a story. So Baghdad Bob from the Wall Street Journal. So it was the chief economist of the National Association of Realtors. His name was David Lira. He wrote a book, I think in 2005, saying, "Are you missing the real estate boom?" And then in 2007, he says, "It appears we have established a bottom," in January of 2007. Obviously, everybody knows how that played out. So he was nicknamed Baghdad Bob. So that's the backstory on the former chief economist of the National Association of Realtors in the U.S. there. So I feel like our version here in Canada is Phil Soper there at Royal LePage. Have you guys ever seen his interviews?
No, I don't know who that is.
He goes on like the Financial Post all the time. It's like just pumps housing. I mean, can't blame the guy, obviously being CEO of Royal LePage, one of the largest brokerages in Canada. But anyways,
So just one more thing. So Keith, the what you were talking about was the Fed dot plots. That's what is that not what it is?
No, it's another one. I'll find it.
Okay, sorry.
You-
Okay, because
You keep stalling for me, and I'll find it.
okay, well, so people are probably wondering what the dot plots are. So every quarter, I believe, the Federal Reserve publishes.
That's gotta be your new pickup line. Hey, have you heard of the dot plot?
So every quarter they pump out a thing called as measures of central tendency or something like that, where I can't remember what it is. They do a forecast of GDP growth, of inflation, which they always get wrong. And they also pump out the Fed dot plots, and you can see. But what they do is they have everybody. Each dot represents all of the people, men and women on the board, some voting, some non-voting. And they basically suggest over the next, either year, 2 years out, 3 years out, and then something they called this nebulous one called long term. And so what you can see, if you just Google it, it's actually quite cool. You can see what their expectations are for interest rates, 1 year out, 2 years out, et cetera, et cetera. And people are always obsessing about the dot plots because they think that they're going to provide some kind of insight on what the Federal Reserve is going to do. I don't know. I think it's overdone, but it's just something something you guys can, do something to keep up at home and check it out. It's actually quite cool. It's actually really also intuitive. You don't have to be an economist to figure it out. It just tells you what the interest rates are, and each dot is sort of like a vote as to what they want to do. But it's something people pay a lot of attention to. And I think maybe that's why why the markets are rallying, because they expect some kind of, a cut in over in the next 2 years or whatever. I don't know. I haven't figured it out why.
No, I'd love to get into that. I don't know if you guys, Keith's got the Bloom tubes up right now, but are you able to look at the pricing and market in forward markets here, just to see where they're pricing in the Fed interest rates and even the BOC? Because I've got maybe the next Twinkie bet here. This is just my own personal prognosis. Please don't make investment advice off of this, but I'm going to go out on a limb here as a guy that's been wrong on central bank interest rates this year for the most part, that the BOC will slip in another 50 basis points in September, and they're done.
Interesting.
50 and done.
What would that bring us up to? I guess I should probably know that.
I'll bring you to 3%. Bring you to 3%.
Mm-hmm. That's what the market is pricing in right now.
Yeah, Keith said that last week, I think.
Is the market pricing in BOC 50 and done?
No, they're pricing 50 for the next meeting. So here's
after that.
Steve is not really being as brave as he thought he was.
No, what about after that? After that,
they have 20.
50. They're done for the year.
Yeah, that is a little less than what the market is saying. 50 and then a 25. So basically, like 3.25 should be the pretty close to the rate at year end. That's what we're looking at. I don't have a thought on it yet. I think we have like 5 weeks coming up here. I think to the next meeting, September 7th.
I think the data is just gonna look horrible over the next 5 weeks. But
yeah, it could, and I think they'll clearly raise rates again unless. Remember, they speak with the commercial banks every day. So if they start to hear a lot of softness taking place in the mortgage or loan portfolios for banks, they may not even do 50. So how about this? I'll say they're only going to do 25 at the next meeting. I'll be the.
Are you hold on? But are you saying 25 and done for the year?
No, 25 for next meeting.
Wow.
Well, that's not fair.
Yeah.
Look at Keith stepping out on a limb.
What I'm basically thinking is I think like September will be their last rate hike period. Like I don't care if they go 25 or they go 50, but I think they're done.
We could, because August is the dead month of the season for the whole industry, right? I mean, we get some data points coming out, but none of the central banks are meeting. It's just guys like us, coming up with a stupid number, and then
bored in the summer.
Yeah, and then and then when the media comes around and said, "Oh yeah, Keith looks really smart again," and Steve doesn't, so something like that.
Probably.
Yeah.
Probably.
It's usually how it goes. Rich?
It'll be likely. But again, guys, we got again, I can't
Hey, hold
stress
on.
enough, the banks.
This guy's gonna make his prediction. Twinkie's on the line, sir. Richard.
Oh, me?
Yeah.
Oh my
you.
goodness, I didn't even thought of it. No, I'm gonna stick with the market. The market's pricing in 50 basis points. I'll go with 50.
Are you saying 50 and done?
Oh my goodness. Nah, I'll take the over. You got the under, and Keith somewhere in between.
Okay, 50, and 25. There you go.
Oh, there you go.
You should switch it
good
to
one.
eating a pizza instead of a Twinkie.
I much prefer a pizza.
Hot dog.
Then we'd all want to lose, right? That's when we'd all want to lose here. Another data point that was really interesting this week. I saw that the Canadian pension plan, I think they're down 15%.
Oh yeah.
Was that year to date or 1 year number? I don't know what it was.
They need to hire Ice Cap.
Yeah, we don't quite meet their threshold for some parameters.
ESG.
Yeah, they're down 15%. Here, let me just pull it up for you guys. So they've got pull it up right now.
I think I'm the one just in general. I think I'm just have a rosier outlook on the economy, I think, than most people, which is
no,
backing up my.
Can't you just be bearish, man?
I know. It's just, I think we've talked about this a lot. When you're out of this severe dislocation, you get these major whipsaws, and I just think we're in one of these whipsaws. So you can call it a recession, and not to like pump Joe Biden's tires. That's not really my. I'm definitely not trying to do that. But I think all this talk about it is way too much. There's too much emphasis on that. But anyway, sorry, I stalled, Steve. So tell me.
Yeah, but one thing for that, Rich. I mean, the estimate for today's GDP was a plus. I'll get it for you here. Just 1 second. So for the American number, the estimate was plus 0.4. And the number was like minus 0.9. Like that's a huge miss. And
yeah, I get that.
Minus 0.9 it's not a big number itself. The point is things are slowing rapidly. And I know you mentioned, or consumer spending was up, but it was up less than the previous quarter. I'm just commenting. I will become incredibly positive at some point, but I just
think it misses the forest for the trees. I think it misses for the forest for the trees. Like when we were getting out of the COVID lockdown, GDP growth was 10% or some ridiculous number like that. And I don't think that's indicative of
it
where
was 35. It was like plus 36.
Well, that's exactly my point. I don't think, you can't, when you're like unlocking your economy from these policies and you're dealing with these, like this major shock, I think you have the reverberations that I think make the subsequent quarters of growth, positive, negative, et cetera, sort of meaningless. I think that they were always they're going to get these, these calls wrong. They're going to surprise the upside, surprise the downside. I think we're in a period of recovery. And I think we're slowing to a more sustainable number. So yeah, sure, call it a recession if you want, but they're still adding something like 400,000 jobs to the labor market, and jobless claims haven't budged. So I just don't think it's as negative as people are making it out to be. I can't believe I'm defending Joe Biden, but
sound like Powell too. Jesus.
And Yellen. You sound like all of them, Rich.
No, I'm in the wrong corner.
Get this guy off the show. You're gonna get bashed in the YouTube comments.
The three faces of Rich. Boom, boom, boom.
So the article here says equity market volatility has resulted in a sharp decline in returns for Canada's pension plan investments. The latest Northern Trust Canada universe for the second quarter of 2022 was down almost 9% for the quarter and down more than 15% year to date.
Yikes.
That's a big number. Yeah. It's minus 15 year to date. That's
that's
in line with Steve? A lot of the
happy retirement. Choke on that.
Steve, do they split it out between stocks and bonds? Do they know where most of the contraction has come from? Or is it just like, are they running sort of a balanced portfolio with like 50-50 or whatever?
Okay, bear with me. It says among the biggest impacts for pension plan investments, Canadian equities as measured by the S&P TSX Composite Index declined 13.2% for the quarter. All sectors were in negative territory. U.S. equities measured by the S&P fell 13.4. I guess it doesn't really tell you where they're.
Okay. Well, I mean, we know bonds are 20% off their highs, right? And in total return terms, which is incredible. I know we've had a couple of good weeks like strung together, but bonds in general, just unless you timed it perfectly, you're probably still underwater, from 2 years ago, which is quite incredible, actually.
Definitely feels like much too early for a victory lap on the bond call here, but
yeah, I agree.
I guess for again the Canadians circling back on the the doomsday predictions here, and obviously I think everybody right now is certainly bearish housing. It's hard not to be. But that Canada 5-year bond, as of today, reading it, pulling it up right now, Canada 5-year bond, which is I think the most important metric in Canada, down to 2.6%. 2.6. You're down off the highs of 3.4. 3.4 in June 20th. So like a month later, we're down, what is that, 80 basis points?
So just so people understand that, so people understand something is just when yields go down, bond prices go up. So we've had a really good month for bonds as people are worried about growth. And that's usually the way that works after getting absolutely caved in the previous, X amount of quarters or whatever.
Hey, Rich, how does a diffusion index work?
Oh, you make fun.
We love you. We love everyone here.
Technical stuff is important. You got to read, the fine print. I'll tell you what, that's definitely come off though, is the bond volatility. We talked about this, and spreads. So we also discussed this. I mean, not in Europe. Spreads are still high in Europe, but spreads for corporate bonds, AAA rated bonds, CCC rated bonds, so investment grade, high yield corporate bonds, it's all off the peaks. So, this is why I think it's very, you got to be really careful when you read articles about a recession, you talk about Joe Biden. I mean, these guys they're lagging indicators, you know what I mean? So when you're thinking about stresses in the economy, where there's going to be a mistake, I submit to you that you got to keep an eye on these spreads and these spread products, whether it's in Europe, whether it's in the US, that they've come off almost 100 basis points since their peak from, maybe it was February or whatever. And so you look at, it's just, this is why I think it's got to be, it's just too easy to sort of, sometimes, when everyone's pushing one way, I think it's important that you just take a breather and look around at the data and see what's going on. And the credit markets are not telling you you're in recession. The credit markets are telling you that maybe the worst is over, but we'll see.
Aren't spreads blowing out right now?
No, they've come in. They've come in over the last, 2 months or 3 months. I mean, they're still high, but they've come in considerably. And this is in Europe. This is in the US. This is investment grade. This is high yield corporate. So we'll see. I mean, it might change tomorrow. Who knows? I could be wrong. But just something to keep an eye on going forward.
I got my bond friend sending me charts on the Canadian bond space. It says forward rates, both US and Canada, showing 3 cuts in 2023. Second chart, Canada financial stress is almost at pandemic levels, which he thinks equals a BOC policy error.
Yikes. I mean, I don't know.
We'll see. It's a complicated market out there, so
for sure.
If you have a lot of things are all over, if you have a lot of conviction, throw a Twinkie bet on it.
Well, things are all over the place, right? If you look at commodity prices, I mean, something that's negative. I mean, copper is down, 25%. We talked about agriculture products last time. Grain is down, has collapsed. Oil prices are off. But it's just, I think this is why people are so confused. I'm confused, frankly. I don't really know what's going on.
But that's also like the fun one, or not like the fun. That's the one that like gets me the most like curious, because it's like, I think like the macro story for like long commodities and these shortages, like obviously the grain shortage, the lack of oil, CapEx, structurally you're like, oh man, like how can prices fall, and yet they're falling, right? So it's I mean, Keith, you talked about, I think last episode, like this could be the markets, playing short term, making some trades here on lower and weaker growth, but like structurally it's hard not to be bullish commodities. But who knows? I don't know. I mean, markets have been wrong before.
Yeah, again, like our view, this is going to be a 1-2 month rebound from what we just experienced. And I do suspect that we are going to get more market stress again coming up. So, this is a good rally now for equities. So people are making some money. They're coming up off the lows they had on their June 30th statement. So that's great. Like that's really good. Those pension funds are now down as 15%. I don't think people realize that with the big pension funds, they're not active from an asset allocation perspective. So if they started the year with, say, 30% in the bond market, like they're always going to be at 30%. That's not going to change. They do not view the bond market as an investment. They view it as a way to offset their future liabilities, as the payouts they have in the pension fund. So they have what's called like asset liability matching, or they want to immunize the liability they have coming up. So if we are getting a rebound in the bond market right now, so that part of pension funds, so that is rallying as well. But if the rally is only for a couple of months, they will not all of a sudden, reduce their exposure. So that's, you have that coming up as well. But you're right, Steve. Our view remains the same here. I think this is the narrative. So far, we've been right with it, and we'll see now once we get into Labor Day. But that's when things will really start to cook up again.
You can almost shut off your screens here for the rest of summer. Go enjoy it. Go party with Rich in Montreal, and come back here in September. But I think it's a good way to wrap it up. Like I said, as always, we appreciate your guys' support. Looking forward to working with the Shake Pay crew. We'll be sort of announcing a little bit more details as the weeks progress here. But continue to share this episode with at least one family member, one friend. As always, we'll see you next week.